Hey, it's Christy. Thanks for joining me for another video. I want to talk about the experience and the feeling of getting pre-approved all the way through finding your home and getting to closing day. It's a really big, extraordinary event. So I want to break down every one of those little milestones as you go through this process. So thanks for being here with me. Let's get it started. Most people equate buying a home with what it must be like when you go to buy a car. So you're shopping for a car online, you find the perfect one, you drive to the lot, you test drive it, you want to take it home and own it. And so you walk into the finance manager's office and you talk about what terms would be perfect for you. They pull credit, you guys figure out what that monthly payment and your down payment will be, and you leave with the keys and you know what your new payment's going to be when it starts in 30 to 60 days. That's the opposite of what buying a home is like. And that's where a lot of confusion comes in, because we tend to relate buying a home to the only other big purchase in our life, which is buying a car for most of us. So when you are preparing now to purchase a home, it's really important to start off with the pre-qualification and the pre-approval process. So let's dive into what that looks like. You call your loan officer that is recommended to you by a friend or family member, somebody who's worked with them in the past and had great things to say about them, or who your realtor recommends for you. A lot of times that lender and realtor partnership is really important. It's sacred. They have great communication. And the reason that realtor is referring that loan officer is because that person's doing a bang up job, or they would not get referred over and over again. So you can trust that. If you like your realtor, you should be able to trust that recommendation for that loan officer. So it's really important too to shop. I don't mind it when my buyers shop me. What's important to that is don't go to all of those places that are going to pull your credit a million times, like LendingTree. They sell your information to at least 40 different lenders, and for weeks, if not months, you're going to get beat up with phone calls and text messages and emails. You will get just bombarded with it. So please don't do that. But maybe check with your bank and who your realtor has introduced you to. It never hurts to have a second opinion, and it also helps people get pretty competitive if need be. So you're going to start with the conversation, and it's really going to be quite an easy conversation. It should be information that you should know right off the top of your head. So full legal name, social security number, date of birth, where you've lived and where you've worked, covering the last 2 years. We're going to ask about your assets in the bank. We're going to ask about your income. We get permission to pull credit, and we also want to find out about your goals. Where do you desire your maximum monthly payment to be? How much money do you have to work with? Whether it's cash money that you have in your bank accounts, or you're going to borrow or take from your 401k, or mom or dad is going to gift you some money. Let's talk about what all of that looks like for your cash to close, and then work backwards to what that price of the home should unveil itself to look like. Now, here's where I see that some people trip up. They fall in love with the house first, and then they call me. And that's where the problem lies. Now, they're going to spend the next few years of their life living in this home, justifying that payment because they love the home, even though it puts them in a payment scenario that really doesn't benefit their family. Maybe it's higher than that 33% of their income, and so they're feeling a little stretched. Maybe they have to give up some other things in their life, and that doesn't always feel good. So to get pre-approved, we typically have to have 4 pieces of information: your identification to prove it's you, 2 years worth of W-2s if you're a wage earner, so you're a salary or hourly income wage earner. And then if you are not, if you are self-employed or 1099, you get commissions, bonuses, those kinds of things, then we'll have to have 2 years worth of tax returns. We want 2 months bank statements, and we also want 30 days pay stubs. If you're self-employed, we'll have to put together a profit and loss statement that brings us from January 1st until current date. And if you're self-employed, you know what that means, so I shouldn't have to break that down for you. Okay, so having those things, I collect it and I analyze it. Now, let's say your bank statement has a big cash deposit of $10,000 just last week. I'm going to have to prove where that money came from. If we can't source it, we may not be able to use it. I'm going to be looking at your year-to-date income and make sure it aligns with your hourly and salary. I know last year many people were out of work for several months, so we wrote a letter to say, hey, from this month to this month I was not working at this place, but as soon as things started opening back up again, I went back to exactly my same position, exactly my same pay. So that's really important to demonstrate the stability of your income. Now, we do want to collect W-2s for all employers that you've had, again, covering the last 2 years. But we're looking at your current income. So let's say you just started a managerial position a couple months ago. We can use that income. We don't average it out over the last 2 years. When something is averaged is if it's commission, bonus, tips, those kinds of ways of getting paid, that's when we would average it out. But if your hourly salary, it's what you're currently earning. And we do look at your hours. So if you told me you work 40 hours a week, but it's really you're averaging 32, 33 hours, we need to use the actual pay that we can demonstrate. If you get paid under the table, unfortunately, we cannot use that income. So just make sure that you are not adding that into what you think you can get qualified for when you're talking to your loan officer. So now we've pulled credit, you've got the credit scores that are required. So in most cases, for most loan types, we want to see a 620 or higher. There are exceptions to every rule. FHA will go down to a 500 credit score with 10% down. So there's all types of loan programs. I don't want to get too deep into that right now, but 620 or higher is desired. Every time you're higher by 20 points, it's going to improve your interest rate a little bit. So the rates that we're looking at typically have a pricing adjustment every 20 points. So 740 and higher tends to be perfect on paper. So if you're looking to get to perfect status, then 740 is going to be your personal aim. So now that we've pulled credit, put together the loan application, we agree on you're in a really great place for your monthly payment, for what we can show for your income and your debts, then now you should feel ready to go out and home shop. So now you know the price of the home that you're looking at. You've got a really great idea on what to anticipate for your total cost out of pocket come closing day and what your monthly payment's going to look like. We can only estimate taxes and insurance and even interest rates at this point because we can't lock in an interest rate until you go into contract. And you might be shopping for months, so who knows what's going to happen to the marketplace in terms of where the interest rate is going over this time while you're shopping. So now you've gone out shopping, you found the perfect home. You and your realtor are going to make an offer and it's going to be in writing. Typically it's electronic and you just have to push a couple buttons, but you guys are going to determine what it is that you're going to offer. It's not only about the purchase price, although that's really important. Are you satisfying what the seller wants to net out of their sale of the home? So you've made a strong offer with a closing date that satisfies what the seller needs. What do I mean by that? Let's say the seller is buying a home or building a home. They might need some extra time in there for the closing date. They might prefer a 60 or 90-day closing date. If they want to move on as quickly as possible, you're likely closing in 30 days. So what is really important is most people start within 4 months of when their lease is up or their desired date to move. And I say 4 months because your credit is good for 4 months from the date that we pull it. And as long as you close within those 4 months, typically for most lenders, you won't have to re-pull that credit report. So now you've presented the offer to the seller. Sometimes that goes back and forth like a little volleyball match. Somebody gives, somebody takes, but you're working on making it a win-win situation for both parties. And sometimes the seller says, this is an exceptional offer. I'll take it. Let's go. Now you are officially in contract. And this is when all the bells and whistles start going. So here's what happens. Typically, you have 3 days to get that escrow deposit or your upfront monies over to the company you're going to be closing with. It's either a title company or a law office. So you have to get that dollar amount over. We refer to it as your good faith monies, and you and your realtor had decided what that's going to be. It was part of your offer up front. There are some states that do this a little bit differently. I know New York does it different. I am not licensed in New York, so I'm not talking to you, New York, if you're watching this, but here in Florida, I'm demonstrating an overview of what happens here. A lot of times it's somewhere between $1,000 and $3,000 up front. So if your goal was to be out of pocket a grand total of $20,000 and you put $3,000 in escrow for that deposit up front, then we'll work on making sure that it's $17,000 remaining all in, so that way we can not exceed your $20,000 goal as far as your maximum cash out of pocket threshold. So that money is sitting there, and now you've started your inspection period. Typically on a contract, you have somewhere between 7 and 15 days, but the most common number I see is 10 days for your inspections. So you hire an inspector, and be careful here because you are paying somebody to tell you everything that's wrong with that house. So you're going to get a laundry list. Most of those things are going to be really easy. You spend a couple bucks at your local, Home Depot or Lowe's, go and buy those things and just remedy it yourself. Some things may require replacement or repair by a professional. If it's going to be something very expensive, really consider moving forward with the offer as it is. A roof can cost anywhere from $8,000 to $20,000. A septic system and drain field can be anywhere from $6,000 to $14,000. A new AC unit can be anywhere from $6,000 to $13,000. So keep those numbers in mind. If everything that I just mentioned or anything that I just mentioned is at the end of its economic life, that means it's going to fall on you as the owner of that home if it's not remedied beforehand. So where would you come up with that money? We don't want you to have all of this money go towards your down payment and your closing costs, and now you're a first-time home owner only to find that you've got to come out of pocket with tons of money to replace something that is one of the most expensive parts of home ownership. So just really be careful there. Make sure that there's at least 3 to 5 years worth of economic life on anything in the home that you're considering buying, especially as a first-time home buyer. So let's say you get your inspection report, everything looks good, you're proceeding forward. What's happening in the background with your mortgage loan? Because remember, you're getting financing and you're buying a home. So there's these two major events that are happening at the same time. One is required to happen for the other to happen, right? So as you're working on the home stuff, we're over here working on the loan approval. So those pay stubs, bank statements, all of those things that you've provided for me, I'm submitting to the underwriter, who's the decision maker on that loan, and they're going to review that information and make sure that it falls inside of the guidelines for that mortgage loan. You really shouldn't have gotten to the pre-approval process unless you qualify, which means you've been submitted into an automated underwriting system. And that means that somebody has aligned what you have, your credit profile and credit scores, your income, your money down and the money in the bank, and align that with the guidelines or the requirements for that mortgage loan and have gotten an automated approval. It's a pretty cool system that we do before we can write a pre-approval letter. So now all that we're doing is submitting it to the underwriter so that he or she can kind of go through that checklist and say, oh, yep, look, they said that they make $50,000 a year in income. I can verify that here, check. They said that they have $25,000 in their bank accounts and their 401k amount. Okay, check. So they'll just go through and make sure that what we've provided and what we've entered in as far as that information aligns. Once you're through your inspection period, I typically order the appraisal. So the appraisal is where we hire a third party that's approved through the lender, and the appraiser is very experienced. They've got a ton of education and experience under an appraiser before they can be their own appraiser. And what they're doing is they're looking at comparable homes to yours within a 1 mile radius if possible, and only within the last 6 months has that comparable closed, in other words, sold to somebody else. And then they make some adjustments to make that home as identical as possible to your home. So they're really looking for the same square footage, same room count, same age. I mean, if you're looking at homes that were built in the 80s, it's a very different type of architecture than homes that were built in the 40s or built in the 2000s, right? So they try to find homes that are in that same era as far as age and also style. So the appraiser is going to provide a report with at least 3 sold comparable homes and their adjustments, and they're going to tell us what that value of that home should be according to their report. If that appraised value comes in over your contract price, congratulations, you are moving in with instant equity, but not much we can do with that at this point. It doesn't mean that you can necessarily get a higher loan amount or something like that. Where the problem might lie is if you are buying a home where the appraised value comes in less than that contract price. If it comes in less, your agent has to go back to the listing agent and renegotiate those terms. So there's a couple of things that can happen. You can come up with the difference in that shortage from the appraised value to your contract price. You and the seller can split it somehow, not necessarily 50-50, it could be 50-50, but whatever winds up being a mutually acceptable amount, or the seller can come down and match or meet that appraised value. If none of those things can happen, unfortunately, that contract might terminate and you may not be buying that home. So why is the appraisal so important? There's 2 major things that are really important for that loan approval. It's your ability to repay, so that's why they're looking at your credit, your job history, your income, your assets. But the other really big part of that is the collateral. And the collateral is that home. That's because the mortgage is a secured debt and it is secured by that mortgage loan. And if the collateral isn't in safe and habitable condition, and if it doesn't meet the contract price, we don't want you to overpay for the home any more than you want to overpay for the home. So that's why the appraised value is so important. So let's say we're fine on the appraised value and we've gotten approval from the underwriter. There's 2 layers of approval. Our first layer is the conditional approval. It means congratulations, you are approved, but we have some conditions that we need to work through. Maybe we haven't had that appraisal report come back. Maybe you haven't selected your homeowner's insurance. Maybe the title work hasn't come back. Title work is where a company pulls some information on the whole history of your property, making sure there's no loans or liens against this property. So that way, when you purchase it, it's free and clear of anybody else's garbage, except for the loan that you are getting with this mortgage that you put against the ownership or the title of this property. So we will not let you close unless we have clear title. What's important about title and title insurance? So title insurance ensures that we have a clean and clear history report. That property has likely transferred hands and ownership many times, right? So we want to make sure that it has transferred ownership properly and legally and fully disclosed. What you don't want is somebody knocking on your door in 3 years and saying, hey, my Aunt Mildred used to own this home and she left it to me in the will. Look, I'm the rightful owner of this home. That title insurance will help make that situation go away because they've proven that ownership has transferred properly every single time. If there's a blemish, they have to remedy it by going back to those parties that it transferred with and making it right. I've seen this happen when it's a foreclosure home and the foreclosure lender has taken title. Sometimes there were other people that were involved that weren't made party to that deed and they have to go back and re-record it. It can be a mess. It's really unusual, so don't worry about it. What I do want you to know is that we will not let you close unless you have clear and clean title for that property. So now we're working together to clean up all of those conditions, provide whatever is necessary in order to be able to resubmit for our final approval. This, you guys, is my favorite part of this whole process. This is where we get our clear to close. And clear to close means, A, I won't ask you for any updated documents. I won't be calling saying, hey, I need one more pay stub. Hey, your bank statement just cut. Give me another bank statement, which is likely where I'm going to be asking when we get our conditional approval. Sometimes we have to freshen up that file and give as updated information as possible. So let's say we pulled that all together and we've resubmitted back to the underwriter. We've got our appraisal in, we've got our title work in, we've got insurance, and we're ready to go. We've submitted it in. Sometimes we have to wait 24 or 48 hours and it's just nerve-wracking. We're so excited, can't wait for that. And then you get your clear to close. This is where you do the happy dance, you're celebrating, because this means there's nothing that will stand in the way of you being that homeowner as soon as your closing date arrives, unless you do something ridiculous. So hear me now. Don't go open up new lines of credit. Don't let anybody pull your credit unless it is like the utilities company or the insurance company in which you have to have in order to have those services when you go and buy your home. Those types of pulls are soft inquiries. It's not going to affect you. Don't go buy a new car. Don't open up new credit lines or credit cards. Don't go to the furniture store and get a new credit card and buy your furniture. You can do all of that after you close on the loan and you've bought your home. You have your keys. Everything's done. Go do what you've got to do. Please do not switch jobs in the middle of this process. Underwriters hate it, and it could jeopardize your approval. Please don't quit your job. Don't quit your job. I've had somebody go, is that important? You can no longer make that mortgage payment because you no longer have income coming in. And by all means, don't go and start your own company. I've had people say, hey, I'm getting ready to quit my job and start my own business. Great. I want you to do that after you close on your home loan. Do not do that now. I encourage you to be a self-employed business owner if that's what you want in your future. But you cannot do that right now. You have to have 2 full years of business ownership and income proven in order to get a mortgage loan in most circumstances. So if you quit your job to go start your own business, you are not getting a mortgage loan. So at this point, you should be a few days before your closing date. You will receive what's called an initial closing disclosure. We refer to it as a CD just because it's easier to say. Your CD will reflect your interest rate, your monthly payment, your cash to close, and all of your closing costs, and you'll be able to review that with your loan officer at least 3 full business days prior to your closing. So if you have any questions, concerns, or if this isn't what you thought, if this isn't what you agreed to, you need to have that conversation now. It really should be in alignment with the paperwork that you've seen a couple of times throughout the process, because if anything materially changes on your mortgage loan, when you lock in your interest rate, if that didn't happen at application, if the appraisal came in a little bit lower and the seller agreed to sell the house to you for less, then we're changing your purchase price, which changes your loan amount. So anything that materially changes, we send you new and updated paperwork to show that. And so you really should be very comfortable at this point with what all of those numbers look like. So we'll go over that together. And typically the day before, you will wire your funds to close to the title company or the law office in which you're going to close at. And then that way, the morning of your closing or the day before, you can go with your realtor, you can do your final walkthrough. So what you're doing is making sure it's left in great condition. It should be broom swept for you. Not everybody hires a professional house cleaner, so you might want to do that before you get your stuff in, but it should be left in good condition. Only one time did I hear about a seller taking stuff out of the walls. It was crazy. They took down ceiling fans and light fixtures. They took out all of the window treatments like the mini blinds and those kinds of things. They took the mirrors off the bathroom wall. I've never seen anything like it at all. We weren't able to close that day. After the walkthrough, the agents had some conversations and the seller went and put everything back in as it was. If there's anything that the seller is going to take with them that is affixed to the home, they have to put that in the contract. So maybe they would say the washer and dryer do not convey. That means it doesn't transfer with the home. You're going to have your own washer and dryer. Maybe they say the light fixture in the dining room does not convey. That means that something very special to them, maybe it was very expensive or it was an heirloom or something along those lines, they're taking that baby with them. So in that case, they should cap it, right? Or replace it with a cheaper version of something, so at least you have something there. Those are really unusual situations. In most cases, you go to the home, it should be in really great condition for you to be able to move in. You might have to show a little bit of grace if somebody, relocated and moved and maybe the lawn hasn't been mowed in a couple of weeks or the pool is green. Show some grace. They're not here to take care of it. Maybe they weren't in a position to be able to pay for somebody to take care of it. But overall, it should be left in great condition, move-in condition for you as you would have expected it. And then when you go to the title company or the law office in which you're going to close in, you're going to make sure that you bring 2 forms of ID. They don't always need 2 forms, but it's good to have that with you. You're going to have your driver's license, and you're going to have maybe a passport, social security number, social security card, your voter's registration card, insurance card, something else that shows your name in case they need to show 2 forms. It usually takes somewhere between an hour and an hour and a half. And if you read every single line item on every single page, you're likely going to be there for a couple of hours going through all of that paperwork. And basically, you're going to sign some paperwork that says, if you pay, you stay, and if you don't, you won't. What's really important in that mortgage loan package you'll be signing is the mortgage, which gets recorded into public records. It's a public known thing. It's a lien against your property, and everybody's going to know it. So you're going to get a ton of junk mail for a couple of weeks once that's recorded. But what's really probably the most important form in all of that is going to be your promissory note. That's your promise to pay. And if for some reason you don't pay back that mortgage as agreed and that lender has to foreclose on you, that's the documentation that they're going to bring in front of a judge. And then you're going to sign that closing disclosure again, and probably a couple editions of it, so everybody has a signed and executed copy of it. So congratulations, you've just experienced about a 30-day process from the time you get approved and write an offer and get your offer accepted to the day that you get to closing. It is an extraordinary process in which is a lot of fun. There's lots of moments to celebrate, and I won't sugarcoat it. It's a lot of work. It's stressful. You're probably not going to sleep really well. You're going to be very nervous all the way up until closing day, but it's all worth it. Think about those really extraordinary moments in your life that had you very nervous. You know, graduating from college or from high school. If you've gotten married, you remember how you feel on your wedding day. Being able to welcome in a baby to your life. All of those things are really big, monumental moments, and they're scary. And if it's worth it, it should be scary, right? It's outside of our comfort zone. Homeownership is amazing, and I hope that you feel equipped to begin this process. If you have questions, reach out to me at questions@creditchristie.com. I'd love to be a resource for you, and I hope that this brought you a ton of value. Thanks for being here with me all the way through the journey.